revenue growth. The second is margins, which tells you profitability, and the third is reinvestment.
But let's say a private equity, I'm just going to use a private equity model, great growth in revenues for a long time, there's no profit, and hopefully they will sell it for a certain thing. So
That's pricing. You're not playing value games, right? You're not building a business. You're hoping that somebody will just pay for a big file of users at the end, right? Dangerous game to play. Yeah? Until it blows up. Okay, folks, welcome back. So a couple of closing thoughts on this bottom-up beta, right? So Clemente, because he's been drinking so much seltzer, is going to describe to me first what a bottom-up beta is and why it's better than a regression beta. I want to see whether you're ready for this argument. Now you've drunk 9 seltzers, you got 3 more to go. So what do we do in bottom-up betas that makes it different from a regression beta?
It's because we are taking into consideration the debt.
You do with a regression beta as well. The only difference in a regression beta is the debt gets built in based on how much debt you had during the period of the regression. So already you can see one issue, right? Companies can end up with more debt now or less debt now than they used to. A regression beta, you're trapped with the past, even if it's right. The business mix you had, the debt you had, with the bottom-up beta, you get to reset those numbers. A regression beta is noisy. Why? Because it's one slice of history. Strange things can happen. A bottom-up beta averages out that noise. And finally, there's one bonus you get when you use bottom-up betas. Let's say I had asked you to value Airbnb when it went public 2 years ago, just before COVID. When you want to value a company to go public, you need to estimate a beta and a cost of equity, right? If the only tool you have to estimate a beta is to run a regression, what would the regression beta look like for Airbnb at the time it went public? What do you need for a regression beta? You need prices and returns. You see already, if you have a private company, a division of a public company that you're trying to value, you cannot even estimate a regression beta because there's no there. There are no prices. So you know what I did to value Airbnb? To get a beta for Airbnb, what did I do? I looked at the hospitality business. I looked at the publicly traded companies. I adjusted for 2 things. One is that as an intermediary, it does fewer fixed costs than other hotels. I adjusted for that. And I also adjusted for the fact that there are much lower debt ratios than the typical hotel company, a Hilton or a,
How do you adjust for such a difference? It's the same business.
It's very simple, right? It's linear. The advantage of fixed cost and debt is the linear adjustments. You're not trying to adjust for something subjective. Because if you tell me your fixed cost and I know my fixed cost, the adjustment is very simply an effect on earnings. So all it does is just magnifies the revenue effect. So operating leverage and financial leverage are very straightforward. The bigger problem with operating leverage is getting fixed cost and variable cost by company. That's tricky because accountants don't break it out that way. But adjusting is actually fairly trivial because it's a linear effect. Now you're saying this sounds like a lot more work than looking up a beta on Bloomberg, right? It actually is a lot less work in my view. And here's why. You'd be amazed at how much time analysts waste on Bloomberg playing games with that beta, changing currencies, changing local to running against another index. For me to estimate a bottom-up beta, what's the only thing I need? I need an unlevered beta for the business you're in, right? That sounds like a lot of work. So to save myself the work at the start of every year, I estimate the unlevered beta for every business in the world. Because I have 47,000 publicly traded companies, I can do these averages. I don't do it for you, I do it for me. So I have the unlevered beta for a steel company, unlevered beta for a chemical company, unlevered beta for an entertainment company. And for the rest of the year, I live off that 2 hours of work that I do at the start of the year because of the unlevered beta for each business. If you go to my website, you click on data and you go to the data page, I think it's the 3rd or 4th item is unlevered beta by business. So you want to value a steel company, you're welcome to use that or do it yourself. I have no problems with you doing either. But it's really not something you do for a company on a company basis. You just do it at the start and use it for the rest of the year. Because unlevered betas by business should not change dramatically from January through March to April to July. Any questions on bottom-up betas? So conventional practice, regression betas, let it go, right? It's really not a great way to think about betas. And I think it's much better to think about betas from a bottom-up beta approach. Yes, Elena?
Is there any adjustment techniques to adjust for rating?
It is. It's very similar to the adjustment for financial leverage. Financial leverage, the adjustment you make is through the debt-to-equity ratio. If you take the financial leverage beta equation and replace debt with fixed cost and equity with variable cost, in other words, you break the cost down, the same equation actually works to adjust for operating leverage. The problem is often informational, because then you have to get the fixed and variable costs for every company in your group. And that's tricky, right? Because if you look at it, you've got to make judgments. Cost of goods sold, how much of it's fixed, how much is variable. The problem is not that we don't know how to do it. The information is just much more opaque when it comes to fixed and variable costs as opposed to debt and equity. But it's exactly the same adjustment. Yes?
So I work in the cannabis space. How would you, like, in the cannabis space, it's always talked about, like, this has never been done before, yada, 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 which I think is just a
We've
way
never smoked something that's put us out of our mind. Oh, no, I think we've done this through history, right? We have substances that put us out of our mind. Guess what? I did alcohol company betas for cannabis for the same reasons,
Okay.
right?
That was
And
the
I
question.
think it's a good question, because what do you constantly hear? This is a new business. Nobody's ever done this before. Really? Nobody's ever taken cars until Uber came along? I mean, we took taxi cabs, right? My point is there are no new businesses. There are new ways of delivering old businesses.
What about the metaverse?
That's a good question. What is the metaverse? It's not a business, right? It's like social media. Social media is not a business. To make money in the metaverse, you got to tell me. It's actually a good question. People talk about the metaverse, but it's just a platform. What are the different ways you can make money in the metaverse? You could make it through advertising. You could make it through gaming. You can make it by taking people's data hostage and blackmailing them. I mean, I know that that's a legitimate business. Yeah? But basically, using things like the internet business, the social media, you can see the reason that this is so dangerous is social media is not a business. You can have a social media company that makes money on advertising, like Facebook does. Always go to how companies make money. That's your business, not the platform you use to deliver that business. E-healthcare. It's not a new business. It's just a variation of an existing business, maybe with a different cost structure. So whenever somebody says, this is a new business, nobody's ever done this before, step back and say, what did they do? And how was it done before? Somebody's been doing this before. How was it done before? What's different about this new variant? Okay, so let's talk about risk premium. So we've talked about risk-free rates. We've talked about betas. Let's complete the cycle. The way I think about equity risk premiums is the price of risk in the equity market. You're saying, what does that even mean? It's what we as equity investors demand as a price for taking on the risk that there is in equities. Do you think that price will change over time? Do you feel a little more unsettled now than you did a few months ago about what the future is delivering? I think so, right? People get more afraid, less afraid. When you get more afraid, are you going to demand a higher price or a lower price for investing in equities? You're going to have to demand. So in crises, equity risk premiums will tend to climb. As you get older, do you find yourself getting more risk averse or less risk averse? Really? You feel yourself getting less risk averse as you get older? You tell me, I mean, if you're getting less risk averse, I probably should push you off the edge of the road there into the oncoming traffic. We get more risk averse. We get more risk averse about everything because a bunch of the things. We have responsibilities. We have children. We have college to pay for, et cetera, et cetera. So you know what that means, right? As populations age, what should happen to the equity risk premium in markets? They're going to go up. You take the Japanese and the European markets where people are aging, at least in the really long term, you're going to see risk premiums drift up because the population is aging. What I'm trying to say is the equity risk premium can't be a static number. It's going to change over time. It reflects the reality you're in. It reflects the events of the times, good or bad, around us. The problem, though, is the way we estimate equity risk premiums in valuation practice is static. I'll tell you how analysts around the world estimate equity risk premiums. You probably talked about this in your corporate finance class. The way they estimate equity risk premiums is they look backwards. You know what I mean by backwards? To figure out what kind of premium you'd earn investing in equities as opposed to something risk-free, T-bonds. I go back at the last 50 years and I say, over the last 50 years, you made 8% investing in stocks and 3% investing in bonds. 8 minus 3 is 5. It's called a historical equity risk premium. When I use a historical risk premium, what am I assuming about the future? It's going to look like the past, right? When is that okay? When is mean reversion a good assumption? When you have a stable structural model. You know why mean reversion worked so well in the US in the 20th century? It was the most mean reverting, stable economy in the history of the world. If you take a history of the world and you graph out GDP growth over time, and you put the US in the 20th century, it's like almost watching a patient go into a coma. The numbers become so, the very volatility, the economy becomes so low. Much of what we do in finance was developed in the US in the 20th century, reflecting that mean reverting, stable economy we're in. I was okay with people using historical risk premiums prior to 2000, maybe even prior to 2008. But to me, 2008 was a breaking point. Because it was a wake-up call to me that this is a different global economy. It's not a global economy centered around the US. We're truly global. That's a structural change. You see where I'm going, right? Even if you have a historical risk premium for the US, I think it's insane to assume that the future is going to look like the past just because you have a 20th century number. But let's start with that number. If you ask me what the historical equity risk premium is in the US, here's what it looks like. That's not even my pointer. Oh, there you are. That's what happens when you have two pointers that look alike. Eh? Here's what it looks like. I update this at the start of every year on my website, so it's free data. If you go back all the way to 1928 through 2021, and you look at what stocks have earned over and above T-bills and T-bonds, you have equity. So I have 12 different numbers. The black numbers are all historical equity risk premiums. 12 different numbers, ranging from a low, I think the lowest number I have is 4%, somewhere over here, 4.47% to 16.47%. If you put me on a court stand as an expert witness and you said, what's a historical equity risk premium in the US? Without batting an eyelid, I could say it's as low as 4 or as high as 16.5, and you can see how it serves a lot of appraisal practices, right? Because if you want to lower the value of a company, what are you going to deliver as your equity risk premium? Pick the highest number you can. If you want a high value, come up with the lowest risk premium. But these all can't be right. In fact, they're all crappy numbers, and here's why. Remember your statistics. When I take an average number across 90 years, what are we trained to do in statistics? Put a standard error below it saying, hey, look guys, before you use this number, you need to know how much variation there is. See this 2.17%? That's a standard error in my historical risk premium. So if you ask me, give me a number with a historical risk premium, and you ask me to nail down one number, I'd probably pick 5.13%. Really long term, stocks versus T-bonds, geometric average, allowing for compounded returns, 5.13%. Sounds very precise, right? Second decimal point. But the standard error in that number is 2.17%. Think about the range on your premium. Plus or minus 2 times 2.17% gives me an equity risk premium for the US that could be anywhere from less than 1% to more than 9%. Historical risk premiums are incredibly noisy. Noisy basically means there's too much variation in stock returns, even if I give you 100 years of history for you to form a judgment about what that historical risk premium is. So even if you believe that the future is going to look like the past is not giving you very much of an indication as to what that number should be. So I've never liked historical risk premiums. And since 2008, I really don't, I think it's asking for trouble to stick with the static number based on the 20th century. So I'm going to offer you an alternative. It's a forward-looking, dynamic equity risk premium. Sounds fancy, but to understand what I'm going to do, I'm going to ask you to think about computing the yield to maturity on a bond. You remember how to do that? Come on, you do, right? How do you compute the yield to maturity in a bond? Somebody help me out here. What's the process of computing the yield to maturity in a bond? So basically, you take the price of the bond, you take the coupons and the face value, and the yield to maturity is that discount rate that makes the present value of your cash flows equal to the price of the bond. That's it. It's an internal rate of return for a bond, right? I want you to think about computing the internal rate of return for stocks. So instead of the bond, what are you buying? You're buying the S&P 500. Start of 2022, that number would have been 4,766.18. So if you're buying a bond, you bought the 500 largest market cap stocks in the US, right? Instead of coupons, what do you hope and pray you will get as cash flows? Well, you're going to get dividends, and in the US, an increasingly large percentage of cash in the form of buybacks. I can't tell you what they will be next year, but I can tell you what they were last year. Last year, that cash flow was 147.24. So I know what you paid for stocks. I know what the cash flow was last year. Here's the final piece of the puzzle. The S&P 500 is the most tracked and followed index in the world. At the start of 2022, analysts tracking earnings in the index were estimating a growth rate of in this case, I think 6.47% a year. I'm not saying it's right or wrong. That's what they're projecting. So here's what I have. I have what you paid for stocks. I have the cash flows last year. I have the growth in those cash flows for the near term. In the long term, I know what the growth is going to converge on. What do we say happens to the growth rate in perpetuity? It gets close to the risk-free rate. So after year 5, I'm made to make the 6.47% converge on my risk-free rate, which at the start of 2022 was 1.51%. So here's what I have as my equation. That's what you paid. There are my expected cash flows. I solve for the discount rate. Solve is too strong a word because it's a very messy equation to solve. I use the solver function in Excel where it tries different discount rates. This is the number. At the start of 2022, that number was 5.75%. Let me back up and tell you what I'm getting out of this analysis. At the start of 2022, if you bought stocks in the US, I don't care what you hoped you would make, what you thought you would make, what you prayed you would make, what you would like to make, given how much you paid for the stocks, and given the expected cash flows, you can expect to make a 5.75% return as an annual return in the long term. Are you happy with that number? Is that a good number? If I had offered 5.75% to investors in the 1980s, I'd have been laughed out of the room. You know why? Because you could have made 7% investing in T-bonds. You know why it made the 5.75% even look palatable at the start of 2022? What's your alternative to investing in stocks? You could have invested in bonds where you made 1.51%. Low risk-free rates and low equity risk premiums. We started this year with a combination of low risk-free rates and low equity risk premiums. I already told you what's happened to the T-bond rate since the start of this year. 1.51% has become almost 3.1% today. It's doubled. Just without even thinking about the mechanics, what do you think has happened to the equity risk premium over the last 5.5 months or 6 months? It's increased. In fact, I computed this at the end of last week on Friday. The equity risk premium, which was 4.24% at the start of this year, is now close to 6.5%. If you felt that the first 5.5 months this year have been a rocky ride for your portfolio, there's a reason for that. The expected return on stocks has gone from 5.75% to more than 9%. It's the biggest move we've seen in probably 25 to 30 years that I've tracked these numbers. Maybe the start of 2000, November 2008, October 2008, you saw a big move. That's an immense move. And what does that mean? If you demand a higher return on stocks, you've got to lower the price you pay. And that's effectively what we've seen happen to the market. So an implied premium is forward-looking based on expected cash flows. It's dynamic. Every time markets change, that premium will change. And to get a sense of where that 4.24% would have put us, given the history of implied premiums in the U.S., this is a graph of implied equity risk premiums in the U.S. There's the 1960s. Incredibly stable period for U.S. stocks. 1970, something is going on, right? Premiums are rising. And what is the triggering factor in the 1970s in the U.S. that caused premiums to go up? It was inflation. Oil prices driving inflation. Oil prices were the trigger, but it was inflation. Inflation is deadly for equities. I started on the story of why it's so difficult to build an inflation-neutral company. And one of the reasons is inflation climbs. Risk premiums tend to climb. So not only do you have higher risk-free rates, you have even higher risk premiums. Until we reach some kind of steady state, this is not going to end. Right? Until we find that point where we say, now we're okay in terms of where inflation is going to be. And I think Salim pointed out, the actual numbers are now that you're getting on inflation are 9-10%. The expected inflation is still around 3%. It might very well be true that markets are undershooting, that we'll go all the way, God help us, if we go to 9%, it's going to look gory at the market level because the risk premium is just going to implode. Even 5% is something we've not seen in such a long time that I'm afraid to see what the risk premium will look like with a 5% inflation rate. So the 4.24% is not bothersome, but the fact that we were pricing stocks to earn 5.75% at the start of 2022. The only justification we gave is there is no alternative, right? This is what we can do. In the market we're in. At some point in time, there is no alternative, starts to run out of steam, right? And in a sense, in 2020, that argument we've been giving for the last decade, so why you have to invest in stocks? Because the alternative is so terrible, bonds, the rates are so low. As soon as that excuse goes away, then you're stuck with this return that you really cannot sustain as a long-term acceptable return on stocks. Now, one of the things I've taught myself to do is every time we're in a crisis, I start to compute the equity risk premium every day. It's almost like torturing myself. It's coming every morning, I would compute. You think, how much can risk premiums change in a day? How many of you were in markets in 2008, last quarter of 2008? Scary period. On any given day, the market would be up 2,000 points. By midday, it'd be down 3,000 points by the end of the day. It was just all over the place. Because people were terrified. They were terrified of every aspect of their life, not just their portfolio, but they'd keep their jobs, the mortgages were falling apart, their house was dropping in value. I computed the equity risk premium every day. From September 12th to 2008, that's a day before the Lehman collapse, to December 31st of 2008. We started the process with an equity risk premium just about 4%. There was a day in November, 8 weeks later, where the equity risk premium in the US was 8%. It terrified people because this wasn't supposed to happen in developed markets. In emerging markets, this was par for the course, right? You're used to this. And emerging market people would put their money in developed markets saying it's safe for them. When you saw this happen in the US, you saw it happen in Europe, there was no safe place to go. It was terrifying. The equity risk premium by the end of the year ended at 6.4%, up from 4.2%. And it took almost 3 years for the equity risk premium to return back to where it was before the 2008 crisis. Long time. Then, during COVID, you remember those February 14th of 2020 when we when COVID first made its entrance into Europe, and I think the Italians reported there were a couple of hundred people in Italy who reported COVID, had not been on a... Until then, we thought it was on cruise ships in China. And then all of a sudden, we decided it's not on cruise ships in China alone, it's everywhere. Between February 14th and March 23rd, we had a market collapse. It's amazing how, it's almost like we have selective amnesia. People have forgotten about those 6 weeks. You remember what happened to equities globally during those 6 weeks? Global equities lost $19 trillion in market cap. 19 trillion. Almost 30% of market cap was wiped out. See what happened to the equity risk premium in those 6 weeks? It started about 4.7%, ended at about 7.7% by March 23rd. That was the absolute bottom. But here was what made 2020 such an unusual crisis. Remember in 2008, equity risk premiums were elevated. They stayed elevated for almost 3 years. It took 3 years for markets to adjust. Go to 2000 after the dot-com bust, it took almost 4 years for equity risk premiums to come back. But in 2020, equity risk premiums, which peaked on March 23rd, by September of 2020, by September of 2020, those equity risk premiums were back to where they were before the crisis. In fact, I wrote a post on what makes 2020 so different. What was it about the COVID market crisis where equity risk premiums came back so quickly to what they were? No.
Print so many money.
Well, if that's the answer, then we'll never have a crisis, right? All you have to do is keep printing money. That's not, I don't think that's going to be the full explanation. I think that might be part of it, as the risk-free rates went down. But I think it remains kind of a mystery, because one of the big issues, my title for my post was The Resilience of Risk Capital, because risk capital in 2020 stayed in the game. You know what I mean by risk capital? Venture capital money, money invested in high-yield bond issues. Take the riskiest parts of the market. They stayed in the game for whatever reason in 2020. First 2 quarters of 2022, you're seeing risk capital withdraw. The question is, will it bounce back quickly like it did in 2020, in which case we're all going to be okay? Or is this going to be closer to what happened in 2008 and 2009, where it's going to take an extended freeze of risk capital for us to come back? It's a huge consequences if you're a young startup looking for VC money. If you're a risky company thinking of going into markets. Because this is going to answer the question of what your reception is going to be, is whether risk capital comes back. Now, one of the nice things about implied equity risk premiums is you don't need historical data. I cannot compute a historical risk premium of any significance in a market like Vietnam. Why? Because there's not enough historical data. Even in markets like India, you might have markets going back in time, but for bulk of that period, it's a very narrow, focused market of family group companies that trade. In most markets around the world, you can't get enough history to even do what I did in the US. But I can always compute an implied equity risk premium for a market, because all I need is the level of the index today, which I should be able to get in any market, the cash flows last year, which might be dividends only for some companies, for some markets, and an expected growth rate for the long term, which is tricky in many emerging markets. And if I can get that, I can compute an implied equity risk premium for any market. April of 2010, for instance, when I was valuing Tata Motors, I wanted to compute an implied equity risk premium for India. So I started with the Sensex, 17,559. I got the free cash flow equity. Remember we talked about potential dividends? Using one to use actual dividends because Indian companies hold back cash, control issues. I used the potential dividends. And I put in growth rates that I was able to get for these companies. I solved for the IRR. I get 11.72% expected return. Based on how Indian companies were priced in April of 2010, they're priced to 11.72% a year. You subtract out the risk-free rate 5%, you get an implied equity risk premium for any market. I'm not ready to do this on every emerging market, but one of these days I will be able to do this on whatever market you're looking at and give you an implied premium. It allows you to come up with an equity risk premium for any market based on how people are paying for stocks in that market. And as you pointed out this morning about some markets which are closed markets, we have no choice but to invest in your own market. You know what's going to happen in those markets? The equity risk premium is going to get pushed down well below what it needs to be because you have no choice. If you're a Pakistani investor with choices, you might say, look, Pakistan is risky. I demand a 9% equity risk premium. But if the only market you can invest in Pakistan, you might set up a 5% because you have no choice. An implied premium is going to give you a measure of how much of a disconnect there is between your market and the global market. One final point before I leave this implied premium space. At the start of every year, as I said, I collect data on every publicly traded company. And I actually compute an implied cost of equity for so I take 47,000 companies and I break them down into developed market companies and emerging market companies. And there's an element of judgment there, right? Do I put Greece in the developed market column or the emerging market column? It might be part of the EU, but clearly it's very much more risky, at least in 2013. But I make my judgment calls, and here's what I do. I do what I did for the S&P 500 for the developed market equities, and I come up with an IRR for developed market equities, and then I do the same thing for emerging market equities. So think of this as the expected return that investors collectively in these companies are demanding. In 2004, the cost of equity I got for developed market companies was 7.28%. Investors were pricing developed market companies to earn a 7.28% return. They were pricing emerging market companies to earn a 10.55% return. These are both in dollar terms. I can compare apples to apples. So in 2004, investors were pricing in an extra return of 3.27% for investing in emerging markets. Why? They're riskier. Makes sense, right? Take a look at that last column and take a look at what's happened to that column over time. In fact, by 2012, that difference had gone to close to zero. Investors were pricing emerging market companies at roughly the same pricing as developed market companies. And remember the stories? After 2008, the line between developed and emerging markets is gone. They're all equally risky. And for a while, that story carried emerging markets upwards and developed markets down to meet almost in the middle. And then you got a wake-up call, which is emerging markets still have risk. Take Brazil. You thought you were a developed market, back to being an emerging market. And you can see the premiums went back up, but then they're well below where they used to be 20 or 30 years ago. The line between developed and emerging markets has become blurrier. It's become grayer. And you can see that in the equity risk premium differences across the markets over time. Any questions on implied equity risk premiums? So in an implied equity risk premium, you're estimating an equity risk premium by using expected future cash flows and what people are paying for stocks. So every time the level of the index changes, the risk premium is also going to change, which is what you want. You want a dynamic premium that reflects the world you're in. Let's now talk about globalization. It's become a bit of a curse word in much of the world, I know. But it's here, right? The genie's out of the bottle. It's not going anywhere, no matter what the politics and the economics are. We're all connected at the hip, as we're discovering with supply chains and everything else around us. And here's how it's playing out. 30 years ago when I was teaching this class, if I had people who are going to work in the U.S., all they cared about was the U.S. dollar, U.S. equity risk premiums, and they went away. Brazilian real, Brazilian risk premium. But today, if you look at companies around the world, especially the biggest companies, what you get are multinationals that through the accident of history happen to be incorporated and traded in a particular market. Coca-Cola, multinational that happens to be incorporated and traded in the U.S. Vale, biggest iron ore mining company in the world. It's a multinational, happens to be incorporated and traded in Brazil. What I'm trying to say is, we're beyond the point where we can say, all I care about is my country and my country risk premiums. Welcome to globalization. To value a company now, you need to know what the equity risk premium is, not just for the country in which that company is incorporated, but every company in which it operates. So again, this was self-preservation. About 30 years ago, I said, I need to come up with equity risk premiums for every country. There was nothing in the literature that we have. So I devised my own pathway forward. I'm not saying it's right. There are lots of flaws to it, but I'll describe how I compute equity risk premiums by country. I start with a mature market premium. In other words, I say, look, I know the premium for the U.S., but the S&P 500 is the largest, most diverse set of companies out there. If I get the equity risk premium for the S&P 500, I have a premium for a mature market. The shortcut to getting a risk premium for another country is you take that equity risk premium, and on top of that, you add the default spread. Remember the default spread I used to clean up risk-free rates? You add the default spread and you stop. And that's what most investment banks do. To get an equity risk premium for another country, they take the premium they use in the US and add the default spread for that country, 2%, 3%, 4%, whatever it is. The problem, though, is that is the spread you're charging for buying a government bond issued by that country, right? But that's not what you're planning to do. You're planning to buy equities in that country. So intuitively, if I'm charging 3% for buying a government bond issued by a country, would you demand a higher premium or a lower premium for investing in that country's equities? I would demand a higher premium. That's where I started. I said, well, how much higher? So I played a little algebra. Okay. I said, I know, let's say that I look at the Sensex, right? The standard deviation of the Sensex is 21%. The standard deviation in the Indian government bond is 14%. So the Sensex is about 1.5 times more volatile than the Indian government bond. My default spread on the Indian government bond is 2%. If the Sensex is 1.5 times more volatile than the government bond, I would expect the risk premium I charge for investing in Indian equities to be 1.5 times 2%, which works out to an extra 3%. So for every country, I start with the base, my mature market premium. I look up the default spread for that country, and I scale up the default spread for how much riskier I think equities are in that country relative to the government bond in that country. But to use this, I need a government bond that is traded, so I can get the standard deviation in it. I need an equity index that is traded, so I can get a standard deviation for it to get that ratio. So at the start of 2022, I'll describe how I got around these estimation issues. Remember that 4.24% that you saw as my implied equity risk premium for the US? I'm going to start with that and make that my premium for a mature market. So today, if I was doing this, that number would be closer to 6% or 6.5%, but on January 1st, 4.24% was my risk premium for the S&P 500. If you're a mature market, I'm going to give you 4.24% as an equity risk premium. You think, how do you know whether I'm a mature market? I cheated. If you are rated AAA by Moody's or S&P, I'm going to act like you're a mature market. I know it's incredibly sloppy, but think of how much time it saves me not to put this category in there. So if you're Germany, Netherlands, Australia, Singapore, you know what they all share in common? They're all AAA rated countries. I give you a 4.24% premium. If you're not AAA rated, my job is laid out for me. If you're Baa3 rated, I go look up the default spread for a Baa3 rated country. Let's say it's 2%. Now, in the normal course of events, I then go find a government bond in that country and an equity and look at the standard deviations. But as I said, it's very difficult to find those in most countries. So I used a shortcut. There's an index. The S&P maintains an index of just emerging market equities. It's a collective index. And S&P also maintains an index of just emerging market government bonds. They're both on the Federal Reserve website. I look at the standard deviations in emerging market equities relative to emerging market government bonds. That ratio is 1.16. What does that tell me? Across the world, equities are 1.16 times more risky than bonds. So I take your default spread of 2% and multiply by 1.16. I add that to my 4.24%, and I get an equity risk premium for your country. So here's what the world looked like to me at the start of 2022. Let's pick a part of the world. Let's pick Latin America. It's a good place to see why risk premiums vary across regions. So the way to see this is the blue is the rating that I got for the country. The red is the country risk premium I estimated for your country based on the default spread times 1.16. And the last column is my total equity risk premium. Now there's going to be no surprises here. The safest country to invest in Latin America was Chile at the start of this year. 4.94% equity risk premium. 4.24% is the US premium plus 0.7% for country risk for Chile. The riskiest country, again, no surprise, is Venezuela, where I'm probably underestimating its risk premium at 24.58%. Why underestimate? Because you can't go any lower than C. For some reason, even if you've defaulted, it seems to leave you at C. But look at how much variation there is within Latin America. Take Asia, right? Safest country in Asia is a city-state. Singapore is the only AAA rated country in Asia, 4.24%, same premium as the US. But look at the variation across Asia. So you've got Bangladesh at 7.8%, but you also have the Maldives and Mongolia at 10.67%. But basically, all this is risk-free, the US equity risk premium plus the additional country risk premium. This is by far the most downloaded data set on my website. It's scary where it gets used. I'm terrified. I see it being used and say, oh my God, don't blame me. Don't put my name around this, because I can't be responsible for the damage you do. I'll give you a few examples. I got an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand when I get this email saying, we're using your equity risk premiums to set milk prices for New Zealand farmers. Which have two reactions. One is, if they start starving in New Zealand farmers, do I get blamed for this? And second, who the heck are you selling the milk to? Zimbabwe? But usually the questions are straightforward. How do you come up with these risk premiums? I have a little PDF file where I describe what I just did, right? I take the implied premium of the US, I get the defaults, but I scale it up. There's no rocket science here. But once in a while, people get aggressive on me. I still remember an email I got from a business person in Lebanon whose business had been appraised for value. He said, what's wrong with your risk premium for Lebanon? And I said, well, what do you mean what's wrong with your risk premium for Lebanon? He said, because the problem is that his appraiser had used the equity risk premium for Lebanon to come up with the cost of equity for the company, and because the number was large, it was lowering the value. He said, why is the equity risk? So his point was, this is your fault. You made the risk premium high. Now I'm getting a lower number for my business. So I said, it's not my fault. How do I come up with the risk premium? What do I start with? I start with the US premium, then I look at your rating that Moody's gives you, and guess what? If Moody's gives you a bad rating, you're in the toilet. I'm not going to get you out of there. So I said, it's not my fault, it's Moody's fault. And that's basically it, right? There is no intellectual firepower behind these numbers. It's not like I'm sitting there saying, I like Brazil, I don't like Argentina. This is entirely driven by default spreads and the risk premiums that come from the default spreads. As I said, this is due for an update. Usually mid-year updates, there's not that much difference from the start of the year. This year, this table is going to look very different in a week. What's the first number that's going to change? What's my base premium going to look like? It was 4.24%. At the start of 2022, it's now going to be higher than 6%. Already you can see every number is going to be pushed up by that. The default spreads have widened by about 30% across the board. So every country, even if your rating stays the same, you now have a much higher default spread. So you're going to see 7% become 11% for most companies, 11% become 16%, and people are going to get pissed off at me and say, what have you done to us? And it's not my fault. I'm just conveying the message that the world has become a riskier place, and guess what? When it becomes a riskier place, your risk premiums have to reflect it. Question? Yeah, I'm sorry. So two questions. Go ahead.
So, sorry, is it that I think what you described as the view, the investor's view
It's fear,
is riskier rather than the
It's fear.
underlying.
Yeah. But do you think it's irrational? I mean, in a sense, it's a fear factor, right? What's driving the fear? That we're heading into recession. We haven't had a serious recession, at least in the US and Europe now for 12 years. We've headed into recession with all these companies that haven't been tested and products that haven't been tested. And we have inflation coming back. This is not some crazy fear, they're making up stuff. There's real fear here. People are going to lose their jobs. They're going to find their retirement funds drop by 30%. So I think there's a really good reason why risk premiums have gone up. In fact, if you ask me, it's not that equity risk premiums are too high now. I think they were too low at the start. I think that was the problem. We let our guard down. We acted like all these things like inflation and recession, the problems of the past. We've solved those problems. Why we're a technological solution to everything. I think the problem is not that risk premiums are going to be too high on July 1st. It's that they were too low on January 1st of 2022. You know where this played out, right? People were paying too much for risky assets because they pushed down default spreads and risk premiums too much. And now there's a reckoning coming where you're saying, no, we probably paid too much. We got too optimistic about the macro events. It's time for a reset. I'm sorry, let me go to Salim first, and then I'll come to you.
And Professor, in our discussion, would you apply this to US dollar?
It's a US dollar premium designed for US dollar-like risk-free rates. Let me explain. So if you're using the euro, I'm okay with you using this. If you're doing it in dollars, Swiss francs, Japanese yen, it'll travel. But if you're doing it in Nigerian naira, where your risk-free rate starts at 11%, or Turkish lira, then my guess is these risk premiums have to be scaled up to reflect the fact that you have a much bigger, much higher inflation number. One simple way to do that is to do your numbers in US dollars and then do the scaling up with the inflation difference, because then everything is going to get scaled up, including the risk premium. So I think that is one solution if you have a high inflation currency, is to do things in dollars and do the adjustment as one goal. Will it make a substantial difference? It'll mean the difference between 22 and 24%. Right, so which can be a significant difference if you're doing a valuation. Kevin?
So you've used Moody's rating.
I use both Moody's and S&P, and for countries where I can't get one, I use the other because they're pretty much matched up.
So there's a disparity for the U.S. now. S&P saying U.S. is AA+.
Since 2012, even S&P doesn't buy it. They stopped talking about it, right? There was the 2012 downgrade. They've never revisited it because they got locked in because of the discussion then. But even at S&P, nobody makes a big deal of it because I think, in a sense, the UK, everybody's downgraded from AAA. The UK used to be a AAA rating. Now there isn't a single ratings agency out there with a AAA rating for the UK. Yeah. Any other questions? You're saying, why do I need this? Because if your company has revenues in Mongolia, I don't care where you're incorporated, I have to bring that in. So the default approach that many analysts use of, you tell me where you're incorporated and I'll give you an equity risk premium based on that, is incredibly flawed. There are a lot of Israeli software companies that get 100% of their revenues in the US. I don't know what makes them Israeli, other than the fact that they have a shingle they've hung up in Tel Aviv saying we're an Israeli company. So if you're a German company that gets 100% of your revenues in Afghanistan, why would I give you a German equity risk premium? So to me, it just seems common sense. But it's amazing in how much of the world you still have this resistance. In fact, German appraisal rules require you to use the equity risk premium of the country in which you're incorporated to value companies in that country. One of the stupidest rules you can think of. I've fought the German appraisal board on this. But you know how the Germans are. They have a rule. They're going to stick with it. Come hell or high water, they're going to. It's a stupid rule. Give it up. But they're stuck with this. If you know where a company is incorporated. So my argument is, tell me where you could get your business, and whether you do it in revenues or operating income or production. I'm completely agnostic. Tell me what your exposure is. And for Arçelik, for instance, their equity risk premiums reflect the fact that they're not just a Turkish company. They get revenues from all over Turkey and parts of the rest of the world. So my equity risk premium for Arçelik is not going to be the Turkish risk premium, it's going to be a weighted average. But as I said, revenues are sloppy, right? Because you can say, what if my revenues all come from elsewhere, but my factories are all in my country? Shouldn't I worry? I think that's a good point. And I made the point about Royal Dutch earlier today, where I said, to compute the equity risk premium for Royal Dutch, I took a weighted average of where they get their oil and gas, because to me that's the risk they're exposed to. That one of these countries from which they extract the oil and gas goes to hell. Essentially, in terms of country risk, all of that production can get suspended, and that has to show up in my equity risk premium. So my argument with equity risk premiums, you tell me where you do business, my equity risk premium is to reflect that business exposure. Any questions on estimating equity risk premiums based on business exposure? I did mention that Lambda approach, which I don't use very often. I use it usually for companies which have a single country that I'm worried about. So I might use it for a Russian company. I say, you know what, I'm valuing Gazprom, and I really want to isolate how exposed Gazprom is to Russian country risk. Because it takes a lot of work to estimate lambdas. I'll tell you the simplest way of estimating lambdas is to take the percentage of revenues your company gets domestically and divide it by the percentage of revenues that the typical company in the country gets domestically. Typical Indian company gets about 80% of its revenues domestically. Tata Motors in 2008 got 91% of its revenues domestically. You divide 91 by 80, you get 1.14. It's a lambda. Very simplistic lambda. But that's what lambda tries to do, capture your exposure to country risk based on your specific characteristics. So I'd look at your revenues, I'd look at where your factories are. I'd also look at what other interests the government has. The more interested the government becomes in you as a company, the more I worry about country risk. In India, there's this company called Life Insurance Corporation that's going to go public, LIC. I think it's the next month or so. It was a monopoly insurance company for India. The government owned the insurance business. It's no longer a monopoly, but it's still by far the biggest insurance company in India. It's going to go public. It's hugely exposed to Indian country risk. You know why? Because through its lifetime, LIC has been used as the lender of last resort, which means when a company gets into trouble, guess what the government does? It puts pressure on LIC to invest in that company so that it can be saved. Even if it means LIC loses money. Their view is, hey, we own the company, we want LIC, and we want the company to be saved. So when somebody asked me to value LIC last month, I said, well, tell me what the government is going to do after it goes public. Are they going to let it behave like a regular insurance company? Are they still going to get into the company and make it invest in other companies that it shouldn't be investing in just because they want to save companies? The government is remarkably silent about what they're going to do at LIC after it goes public. And guess what? The valuations they're getting are way below what they thought they would get. Because people are saying, this is a company that's incredibly exposed to Indian country risk, and I don't want to invest in that company unless I have some clarity.
Once
Yeah.
you have the lambda demonstrated by the
Country risk premium. So basically, instead of consolidating it and having one big equity risk premium that I multiply by the beta, which is what I do. When I have a lambda, I take my mature market premium and multiply by the beta, and I take the country risk premium portion and multiply by the lambda. So it's almost like lambda and beta capture different aspects of risk. Beta captures traditional business risk, lambda is specifically for country risk. Let's talk about growth. There's an overall lesson I hope I've got through on growth is I don't have the power to go around endowing companies with high growth just because I feel like it. Now, you'll be amazed at how many times I value companies. Managers say, but couldn't you just give us a little more growth? I say, oh, I could do whatever I want. But I don't have the power to do it because it's your decisions, your actions that drive growth. What do I mean by that? Ultimately, growth comes from two decisions you make as a company. How much you put back into the business, what you reinvest, and how well you reinvest. If you're a company that reinvests a lot and reinvests well at the same time, amazing, you're going to have a great growth rate. If you're a company that reinvests a lot but reinvests badly, guess what? You're going to have not just a low growth rate, but terrible consequences for value. If you're a company that reinvests very little, so basically your choices on how much you reinvest and how well you reinvest drive growth. So three propositions about growth that follow out of it. So if you look at the equation I use, reinvestment rate, rate times return on capital, that's how you get the growth in operating income. That's how I valued Amgen and Tata Motors. If you were doing an equity valuation, you'd use, instead of the reinvestment rate, you'd use the retention ratio, which is the percentage of net income that you put back into the business. Instead of return on capital, you use return on equity. But in either case, what I'm trying to do is emphasize that if you want more growth, you got to tell me what you're going to do differently. Either you reinvest more or you reinvest better. There is no free growth. I can't go raise the growth rate by 3% and leave everything else unchanged. Second, can you grow and destroy value? Tell me what kinds of companies will have growth and destroy value at the same time? What is the company going to be doing?
Highly leveraged company.
Highly leveraged by itself is not. You can have a highly leveraged company that invests well, right? Your cost of equity will be high, but if your return on equity is even higher, I'm perfectly okay with it.
You're losing money, which comes.
You don't even need to lose money. If you earn a return on capital lower than your cost of capital, and you keep taking project after project doing this, guess what happens? Every time you grow, you will actually reduce your value as a company. For two reasons. One is, the good side of growth is your operating income gets larger. The bad side is you're putting money into reinvestment. The net effect is what's driving value. And if you're reinvesting a lot to show very little in terms of growth, you can grow and destroy value. This goes back to the life cycle point that I made, I think, in the last session. If you're a company in a declining business, you know the best thing you can do to maximize value? Stop talking about growth. Start talking about shrinking, right? Because you grow, you're going to actually be able to grow, but at a huge consequence for your cash flows. Question back there.
So if we don't reinvest, then the money will be redistributed as a dividend?
Or whatever.
Because-
If your own business, take it out, it'll be given back, repay the debt, retire, make your company smaller.
Because do we believe that the reinvestment is worse than the redistributions?
Let me ask you a question. If it's a tobacco company, do you want to be reinvesting money? What do you want to be reinvesting in? This is a shrinking business. I mean, you got to face reality, right? There are some businesses where reinvestment just doesn't make sense. The returns are just not there. In which case, what should you do? You should shrink as a company, whether you pay dividends, buy back stock, pay off debt. You just get to be a smaller company in a smaller business because your existing business is just not worth growth.
So if, let's say, the business gets shrunk, isn't it the value of the company will reduce, and that will
That's
cause
right,
the
but
shareholders, the destructions of shareholders' value?
Is it? How did I reduce the value? I gave you cash. It's in your pocket, right? You have a smaller business and you have $500 in your pocket. Aren't you still better off than me taking that money and investing it in bad projects? Remember, you can't just compare the value of the business. You have to think about the cash disbursements I had to get to where I am. And I gave you a lot of dividends and cash flows, which you can invest elsewhere if you want to. So growth can add value, it can destroy value, it can do nothing for value, and you got to make sure you pick the right path based on the business here. And finally, and this is a point I made earlier, scaling up is hard to do. As companies get bigger, growth will drop off. I don't know why people constantly get surprised when it happens. It happens at Netflix, it happened to China as a country, right? As you get bigger, you cannot keep growing at 10% a year. If you're the second largest economy in the world, I don't even think you're going to grow at 5% a year. I think it's a lie if you claim you're growing at 5% a year. You're probably lucky to be growing at 3.5% a year. It's the nature, it's a math problem that you have, right? If you're a small country, you can grow at 15% a year, but as you get larger, you're going to start to see scaling up catch up with you. So if you think about what drives the value of growth, it's just return on capital. Whether you earn a return on capital higher than the cost of capital. And this is a scary number. And I'll tell you why it's a scary number, return on capital. The numerator is after-tax operating income, which is an accounting number, right? Operating income times 1 minus tax rate. The denominator is capital invested in existing assets. You're saying, what the heck is that? It's book value of equity plus book value of debt minus cash. It's the only place in finance where we use book values. And who computes book values? Accountants. This number has both numerator and denominator computed by accountants, which means that everything accountants do is going to alter your return on capital. Karen admitted during the break that she was an accountant. That's a pretty brave admission given how much bias I've shown against accountants. But everything accountants do does affect your return on capital, right? Do any of you have trouble sleeping? If you do, I think I have the answer to your problems. It's a paper I wrote on accounting returns that was so incredibly boring that I fell asleep multiple times while I was writing the paper. It's 64 pages long about all of the adjustments I have to make to accounting numbers to get a return on capital that makes sense. I'll give you an example. A couple of examples. Two we've talked about already, capitalizing R&D and capitalizing leases. The reason I do this is to get a better sense of what's your true return on capital, because otherwise I get a misguided view. But here are the other things that worry me. If you have a company that's taken a bad project, everybody now has agreed it's taken a bad project. What do companies do when everybody can see a project is a bad project? They write it off. Right? Makes sense, right? You're saying, I'm taking $2 billion. Why it's a terrible project? You're saying, what's wrong with it? So you write off $2 billion. What happens to your book value when you write off $2 billion? It decreases, right? 2 years later, I compute the return on capital for your company. Unless I have the foresight to go back and look back at your write-off, what do I see? I see a low invested capital. I don't recognize that it's low because you wrote off $2 billion. I just see low invested capital. I look at your operating income and say, this company is a great company. It's making a 22% return on capital. If I let you write off your mistakes on a continuous basis, and I'm not saying it's a bad thing, accountants do it all the time, and I compute the return on capital based on that written off amount, I'm going to overstate the return on capital at companies that have managed to write off their mistakes. You think, what's the solution? You know what I have to do? I have to go back and reverse everything accountants have done for the last 10 years. Think of the nightmare scenario this opens you up to. So when we talk about return on capital, the reason I'm making such a big deal is in many consulting firms, this has become this magic bullet. Consultants go, what's your ROIC? You don't know what a ROIC is? You're not one of us. Back away. Okay. It's become this magic bullet that the McKinseys and the KPMG do. What's your ROIC? Your ROIC is lower than the cost of capital. You have a problem. It's higher, you're great. And I understand the allure of having one number, but I also recognize it's an incredibly noisy number. So at the start of every year, I actually do this for every company. I compute the return on capital for all 47,000 publicly traded companies, just as I did for Archlick here. And you can see the return on invested capital is this red number. And you can see, unlike the margins, it's up and down as Turkey goes up and down as well. You see the return on capital. But Archlick has a problem, and it's not a problem unique to Archlick. It's, I think, true for a lot of Turkish companies. Its return on capital over the last 5 years has been about 12%. Do you remember what its cost of capital was with the high inflation they have now? It was like 21%. This is a company that's not just running in place, it's running behind. And it might not be its fault. When it took these projects, it might have thought it was taking great projects, but now that inflation has risen and they're unable to pass it through, they're now stuck with projects that are earning less than their cost of capital. So I'm going to show you what I think is the most depressing graph I produce every year. Every year I told you I compute the return on capital for all publicly traded companies. I compute the cost of capital for all publicly traded companies, and then I compare the two. Here's a simple rule of thumb. You want to earn more than your cost of capital. That's a good company. If you earn less, then you're a bad company. Across all companies, here's what the numbers look like at the start of 2022. 43% of companies earn more than their cost of capital. 57% of global companies earn less than their cost of capital. In fact, if you look at the distribution, you can see there are lots and lots of companies, maybe 30% of all companies that earn returns on capital that are more than 5% below their cost of capital. Now, some of them have good excuses, right? I had a bad year, right after 2020. I'm a commodity company, but commodity prices are low. But at least half of the companies in that worst group have been earning below their cost of capital every year